Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is my thoughts on market happenings for the week ending October 22nd, 2021. The headline is Canada's inflation rate rose in September to the highest level since February of 2003. The 4.4% year-over-year increase in the Consumer Price Index last month marked an acceleration from August and is bound to stir new concerns about the rapidly rising cost of living in this country and the consequences for the Bank of Canada as it attempts to untangle transitory from non-transitory factors. The inflation has exceeded Bank of Canada's target, which is 1 to 3% range, targeting 2% for the last 6 months. So the word quote unquote transitory, very key previously, is leaving everybody's vocabulary. So what can you do? Number one, buy stocks with good pricing power that can pass the price increases on to their customers. Number two, buy financials who will benefit from the increased interest rates that will follow. Banks who benefit from bigger spreads between mortgage rates and savings account rates, and insurance companies that get more for their safe investments of your premium dollars. And finally, number three, buy commodities and real estate whose prices go up with inflation. Gold isn't the inflation hedge everyone thinks it is, according to studies. Secondly, Canadian banks have not been allowed to raise dividends in the last 6 quarters. The regulator, OSFI, or Office of the Superintendent of Financial Institutions, is expected to take the ban away soon, perhaps before the end of the year, because there is no more reason for it. Banks are able to drop more and more reserves against bad loans each quarter as well. One expert on BNN, Rob Wessel, suggested the banks could raise their dividends as much as 25% in the next 4 quarters. On an unrelated matter, I heard a podcast from a few weeks ago that talked extensively about the issues with Evergrande. You remember Evergrande? That whole story disappeared. It was huge and a market driver for perhaps a week. And then the media and the market started focusing on something else and forgot about Evergrande. The media and the market are like a small child with no focus. Once some piece of information has been absorbed into the market pricing, it is forgotten. Oh, look, a butterfly. So, what is worrying the market this week? Number one is that the Chinese economy is slowing. That is not a good sign. Number two, inflation and pending rising interest rates, which harm most companies because of the debt servicing costs and increase their costs, including salaries. And then number three, there are the supply chain issues, the microchips, other components, general logistics, and labor. What is on tap next week? Very importantly, Bank of Canada interest rate decision is on Wednesday, October the 27th. The Bank of Canada will announce its decision on the target for the overnight rate. It's generally expected to hold interest rates steady for now. They may signal that they are starting to look at increasing rates sooner rather than later, however. Scotia's Derek Holt said that the Bank of Canada might need to raise interest rates 8 times by the end of 2023. The central bank's benchmark policy rate would rise to the highest level since November of 2008, if that were true. US quarterly reports are also in full swing, and Canadian companies are starting to report as well. So that has been the observations for this past week and what is happening next week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.